Hey everybody, Preston Brent here with our Trader User Group, a weekly roundup. This is for the trading week ending April 5th, 2019. So we're just completing the first week of the second quarter, and earnings are going to be kicking off pretty soon. What I've got on the screen here is the daily chart of the E-mini S&P 500 futures, but first, just a couple of weekly sound bites for you guys. We've seen the markets this week. Dow, S&P, NASDAQ, Russell, all closing in the green. The Russell leading the way at about 2.82%. NASDAQ followed at 2.7. Then the S&P at 2.06 and the Dow at 191. Meanwhile, we saw the VIX actually come back below 13, finished the week out at 12.82, came down about almost 6.5% for the week. And then across the world markets, they did just as well. I mean, we had the FTSE, which is the London markets, it was up about 2.3. The CAC 40, the French markets, up 2.3. DAX, the German market, surprisingly, finished up 4.2. And the Nikkei over in Japan up 284, and China had a very strong week at 5.04%. So we've had, all in all, a really strong kickoff to Q2. And then here in the U.S., the best sector performer was the materials XLB at about 4.6% up. Utilities worst performer down about 1.16%, 16 bips down. PE ratio is up a little bit, around 16.5. Forward PE guidance. And so, we're getting a really strong look at the markets. Now, this past week, I think what really got the markets in a bullish mood was the prior weekend, a week from today, last week. We saw manufacturing numbers come out of China, and they really picked up very strong. And then throughout the week, we did see a lag in PMI data across Europe, especially in Germany. So that's got some people starting to worry a little bit. But we finished the week with strong job numbers. So it gave us kind of the right mix of low unemployment, solid wage growth, but subdued inflation. So all these numbers kind of just gave us a very strong kickoff into Q2. Now we've seen the Feds really reverse their policies from tightening to accommodating. I mean, their tightening policy gave us our Q4 performance where we had record drawdowns, almost 20% or 20% in some indexes or more and a little bit less in others. And it's kind of shifted. And that was, by the way, that was globally. Globally, indexes, global markets fared even worse in Q4. Now, Q1, we had a completely 180-degree shift in the Fed, and now they're very accommodative. And they gave us the reversal. We had strong Q1 performance records, some of them best in over a decade. The U.S. indexes, some of them are up 13, 14%, others 16%, depending on which index you looked at. That was just as we closed Q1. So now we've got this kind of quandary here because we've got this forced choice. We've got the credit markets that are basically saying that there is a higher probability of an interest rate cut versus an interest rate hike. And we've got a very accommodating Fed. I mean, just global markets are just accommodative right now to the point where we've got, I think it was a Morgan Stanley report that came out a week or so ago that said there's almost 10 trillion in government-backed debt still carrying negative interest rates. That's huge, folks. I mean, that's really huge. And then coming up this June, we're expected to see one of the longest bull runs in U.S. market history. So it's just very accommodative, global central banks. So, we've got this outcome that's kind of uncertain. We've got this huge degree of accommodation. And how, when, and where these global central banks are going to begin to unwind and what's going to happen out of that is just, it's left to be seen. We've never been here before. But meanwhile, we're kicking off Q1 earnings here starting this Friday. We're going to get the banks, JP Morgan, Chase, Wells Fargo. We're going to get PNC, and then a regional bank, First Republic Bank. They're kicking it off this Friday. We're going to get some more inflationary data. It's still subdued in the U.S., but this Wednesday we're going to get CPI data, and then Thursday we're going to get PPI data. So we're going to get some really interesting data kicking off this week. All right. So this is following a very strong week from last week, but I don't see anything right now that's going to suppress the markets. And I know there's a bullish camp out there and there's a bearish camp out there, and they're equally as have logical arguments as to where it's going to go. But as you guys know, how often have you seen price action move in a logical manner? I mean, I think human nature is likes to have more predictive results and likes to bring everything down to numbers and probabilities. But price action, as we've always seen, especially as what I teach our members, we can always have that irrational exuberance. The markets move higher and further and faster than you think, and then they can do the same thing uh, by going in the other direction too. So what we do is we attempt to just follow the price action and play the probabilities of where the price action is going to go, but we're willing to adjust on the dime as necessary. Okay, so if we look at the S&P E-mini futures right now, you can see I've got this regression line on here. It's got a 0.919 rating on it, which means it's a fairly tight regression line. Now, this is a daily chart, but this kind of kicked this off about the middle of June or January, sorry, of this year, when the Feds came out on January the 4th and completely reversed their policy shift from tightening to accommodative. And now you can see we've pretty much, with a few exceptions, have ridden the upper band of this regression curve straight up here. We're at, we finished the week near our 2019 highs at 28.96, and we're not that far away from our our all-time highs, which was made in September of 2018 at 29.47. I believe we're going to take that number out. I mean, we're just moving to that number like a bug moves to a bug zapper on a Sunday afternoon out on your back porch. That's what we're going to see. Not unless we get some really surprising numbers here, because what everybody's going to be paying attention to in these Q1 earnings is not necessarily did they hit for Q1, but where's the forward guidance? Everybody wants to know that. Now, keep in mind, we got the China trade deal that should be wrapped up this quarter, whether it's end of April, early May, or whenever they meet. The markets have priced in a good part of that already. So it's got to be a deal where all trade tariffs come off, and we've got clear sailing ahead to see the markets get a real strong pop. If Trump leaves tariffs on and then just selectively pulls them off as China shows they're meeting their hurdle rates, then I think you'll see the market sell off a little bit on that kind of deal. So, but I suspect Trump will probably pull the tariffs off, and that'll give us a pop. And then once we have that pop, I think it's going to drop. But when is it going to drop? We'll see. And how high will this pop go? I think clearly for all indexes, we'll make new all-time highs. All right, that's that in my mind. The price action seems to be showing that. Not without some pullbacks, but the pullbacks are going to be by the dip kind of thing than anything else. Okay, so that's kind of what I'm looking at. Now let's go over and look at if you'll notice here, we hit 2019 highs in the E-mini S&P 500 futures. Okay, you can see it right here. And we hit it on Friday, just slightly off the highs. In fact, it closed. Now look at the Russell. I've got a regression online that too. But look at the regression line here. It's been going in the other direction, and it's a daily chart, folks. Only on Friday did we break the upper band and move up above that. We're still off the 2019 highs, but I think we're going to take them out. So my concerns prior to this were if you were to put a regression channel on the S&P and on NASDAQ and even the Dow, it would be moving up. But on the Russell, the regression channel was moving down. And this was the exact scenario we had in September, when the Russell peaked early September, and then all the other indexes peaked the middle to end of September. And keep in mind, the Russell being small cap and some mid cap, it tends to lead the markets from a bear market into a bull market, and it tends to lead the markets from a bull market into a bear market. So this is a good sign. This to me is supportive of higher prices to come, because this means risk is coming back into the market, and I like that kind of sign. And let me show you another one that kind of follows the Russell. Let's look at the Dow Jones Transports with the ETF IYT, India Yankee Tango. Same thing, right? It almost looks like the Russell, right? We had this downsloping line here because transports tends to lead the Dow. It did the same thing in September, and then It actually broke out sooner than the Russell, but boom, we came up here and we made 2019 highs on Friday in the transports, led mostly by airlines. So this to me gives me a lot of confidence that, markets are pricing in more and more, each week that comes by in statements that either leak or on purpose coming out of the Trump administration believe that the China trade deal will be a good one. We'll get what we want. They'll get what they want. Tariffs will come off, and then the global markets are going to have a pretty good little rally here. Okay. So that's what these charts are showing me. Now, if we look at the Dow, you can see the Dow here also came right up to my point here. Let me just move this up here to show you guys. We came up. That was my target point right here. Now, I had this target point up here when the Dow was down in this area down here. Okay, back in early March, I said the Dow would come up and hit roughly around 26,422, and it hit 26,509. Now, this colored bar here is a combination of Gann and Fibonacci extensions off these lows down here and this prior pivot high right here, which was an Elliott Wave 3. So this has given us an Elliott Wave 5 print. For those of you that follow Elliott Wave, I don't trigger a trade using Elliott Wave, but it gives me kind of an idea of where the cycle count is as far as movement up and down in the markets. And I use it in a combination with a couple of other things that our members follow us with, and we trade these things. So you can see here with an Elliott Wave 5, it's even projecting an Elliott Wave 5 can extend up here, but I think we'll get this extension once that China trade deal comes through. Okay. So this is kind of what I'm looking at right here on the markets, or the major indexes here. And then, of course, if we look at China, the tracking stock I use is ASHR, Asher, and obviously on Friday we hit another 2019 high. You can see where we started the year way down here, and this just shows you the degree to which the Chinese markets have been very bullish, because they're really playing off of this deal. Because if we take those tariffs off, you're going to see Chinese stocks. I like BABA, BABA, and I like EDU, Echo, Delta, Uniform, for some China stocks that can just, a lot of this movement has already been priced in. Okay. But I still think we can get some more upside of these things. Now, if we look at the VIX, if you look at the VIX here, well, one other thing I wanted to show you here before I forget, All World Index. If we look at the All World Index, we also on Friday ended at 2019 highs. So this is the Vanguard All World Index. So globally, markets are moving faster. Now, the U.S. has just outperformed all global markets, but the global markets, as that China trade deal goes through, then you're going to see these markets really move pretty strong. And Australia tends to follow China. Same thing with Japan and the Nikkei index. So you look at all of these, and it just really bodes well for the market. Okay. Now, if we come over here and look at the VIX, we finished the week at 1282. So we're back into the green again down here, right? You can see I color code the VIX, because depending on what area of the VIX we're in, it could change our option strategies and what we want to do and how we want to deploy them. But you can see we finished the week at 1282. I mean, the VIX was down, I don't know, it was down about almost 6.5% for the week, and here we are right here. Now, if we look at the front month term structure of VIX, this compares the VIX to the front month, right? Let me just get this set here so I get that off the screen here. So you can see here that we're in the green, which means we're in a contango situation. This is a normal term structure for volatility. That means there is no fear going out into April, May timeframe. And then if we look at the back month, comparing April and May term structure, let's look at this one. You can see it's even deeper in the green. So the markets have high expectations and low fear going through May, based on the volatility term structure. So to me, this signals that hedges are going to be cheap, so we'll look at some of those hedges. And then some of the trades I like to do, I call them gators. We put them on, probably once or twice a month. We just did one this week for a small profit, but generally doing them in low vol environments is a really good time to put a gator on, because then when volatility goes up, we get the chomp chomp, and the gator, needs to eat. and we feed the gator with low volatility. The other thing that I'm seeing here is in the E-minis. If we come back to the E-minis here, you're going to see here that the 50 has crossed the 200 very nicely. The red line is the 50. The yellow line is the 200. Now, these are EMAs, okay? If I were to shift the view and make it SMAs, let me just change it and go over to another screen and show you the SMAs on the chart here. Let's get that right here like that. That would be screen number 8. I got a whole bunch of screens here floating around. Let me just see, did I get you the right one here? I think I did, yeah. Okay, so you can see here the yellow line and the blue line, the yellow line 200, red line 50, but these are SMAs. We've got a cross in the SMAs as well as the EMAs, okay? So that means it's time for us to start looking at our volatility trades again. Okay, so we've got a special way that we play vol, and I like playing it this way. So we're going to be entering probably some vol trades when volatility tells us we should be entering vol trades. So we use a combination of VXXB, and we look at the term structures, and then based on those, we get that negative roll yield set up in VXXB. So we're going to leverage that in the coming months, as long as we keep the 50 over the 200, which means we're in basically a bullish frame of mind. And as long as prices stay over the 50 EMA, then I'm okay with it. Okay. Now, if we change the view here, and let's come back to a Bollinger Band view of the E-mini S&P 500 futures, and I'm going to take it down to a 240-minute time frame. You can see contraction of the Bollinger Bands leads to an expansion, which leads to a contraction, which leads to an expansion, which leads to a contraction. So you guys get the idea, right? Expansion leads contraction, contraction leads to expansion. That's just the way the markets move, and it's just the way it always is and always will be. It's just human nature. So on this 240-minute chart, you can see here the contraction of the Bollinger Band a little bit, and then as this move has started to accelerate to the upside, the purple line is a 2 standard dev. The blue line is 1 standard dev. The yellow is the center line, and you can see here the red line is a 3 standard dev. Very rarely do we hit it up or down, right? You can see that when markets are really moving, we can get outside the 2 standard dev like we've had on Wednesday, Thursday, and Friday this week. So a little bit of a pullback would be expected in my mind. Okay, you can see here I've got the Fibonacci nodes on here leading back to the lows that we had in December. So that would mean a pretty wide, extensive move Fib node wise. But we've got the cross in the MACD up. We've got this here. So to me, it just everything just shows continued upward movement. And any pullback is going to be one of those opportunities where we're going to want to buy the dip, right? So now if I come over here and let's look at the same chart, but in this time we're going to look at the Ichimoku, which we also use a pretty good deal in our membership group. You can see here on this daily chart, we got a buy signal back here in early part of January, and we've stayed on that buy signal all the way. Okay, we use the blue line as a stop loss on that, and you can see here that we really didn't get below it, and we haven't been below it since we're coming off the Dece lows. All right, of that when the Feds and Jerome Power Ranger Boom Boom Powell came out and just really crashed the markets when he came out with his statement on December 4th. And then on January 4th, when the market started rolling down, he completely reversed course. And then we went accommodative on January 4th. You can see that big green bar right there is when he completely shifted around because we were on our way back down here to test these lows again, and he just totally shut that down. That just shows you can't fight the Feds, right? And during this entire time frame, outside of the rate cut in Dece 4, which he shouldn't have, I mean, the rate hike that he did in Dece 4, I don't think we would have had this kind of violent move that we did. But we're beyond that now. If I take this down and let's take a look at a 2-hour chart. And if we take a look at this 2-hour chart, you can see here, even on this 2-hour chart, we got a signal to go long if you're trading, swing trading, back around the end of March. and it was like around 2,800. So uh, uh, um, most of this move over this past week would have been met. You would have been smiling all week just looking at the Ichimoku. Now, in our option masters, we spend a lot of time talking about what all these colors mean, because generally when you set up an Ichimoku, most people that are Ichimoku experts and really use it a lot try and color code it so the colors mean the same thing, so it makes it easier to understand, so you don't have to, when you look at the chart, you can just use the colors to tell you what you need to do, like where you've got what most people understand about the Ichimoku are the clouds, right? The green and the red clouds. So, and they mean different things depending on whether they're red or green, and how wide they are or how narrow they are, and where is the trailing purple line and what does it mean, and then the red and the yellow and the red and the blue line. So now we cover that in our option masters. So for those of you that are not members, I would highly encourage you to come in and check it out. I mean, just following some of the things we're doing, you would have paid for our membership probably for the next 5 years. And then the other thing that we've got going on here now is, if we take a look at, let me just shift the screen back. I can do this because I got my T-Rex computer here in my office, the B of A building here in Boca Raton, Florida. The beach is 6 blocks away. I can see the beach from my office window, so that's pretty cool, I guess. But if we look at the look at this, let me just get it over here to screen number 4 again. You get spoiled with all these monitors, I guess. So let's come back over here. Let's come down and let's look at interest rates. Interest rates also did what I had indicated and what the charts were saying here. Here's the 10-year. Remember, back up in this area up here when we were around 275, I said the 10-year is going to come down to 2.5. In fact, when the 10-year was up around 2.78, almost 7.8, 2.78, I said that 10 years, it looks like the charts. If you follow the Elliott wave count, I follow the Elliott wave count until the count changes, and then I see conflicting signals, but I was not getting conflicting signals here, so I put the bar on here, and it said the target was 2.5. And of course, as markets always do, you always overcompensate up and down, and this was when the yield curve inverted, and we had that only week in March where almost every day was down, right? And then we quickly recovered, and you can see we've moved right back up to where I said we should be, around 2.5. So watch the 10-year, because the 10-year, if the 10-year starts dropping, meaning interest rates are going down, bonds are moving higher, then that's going to bring a little bit more fear back into the markets. Okay, and keep in mind, as I said at the opening salvo here in my sound bites, I said that the odds of a rate hike this year are almost zero, and a rate cut is a lot higher. And who would have said that in Q4 when Boom Boom Powell came out with his, very tightening type of Fed stance. So that's a little bit about what we're looking at there. And of course, if we look at energy, right, here's the trend line here. We had a buy signal on oil. Remember, back up in this area here, I was telling our members to get short oil. I did not believe in this move, and I said we're coming down to the low 60s. And of course, we overshot my target, and we came all the way down to the low 40s. But anyway, we had members taking the trade and made a killing on the trade. And then back over here, the mood shifted again. This was more geopolitical than anything else. I'm not going to go into the detail on it. Our members understand what happens. And then back in this area here, I said, let's go long. And then after being long for about a month or two, I put a regression channel on it. Again, it's a very tight channel at about a 0.93. You can see we've pretty much been above the upper boundary of the channel, okay? And because we had such a decimated Q4 in oil, the 50 is still below the 200. I don't think we have too much more upside left. The only thing that's given us this upside right now is the geopolitical battle between OPEC and Trump and Venezuela. And then, of course, on Friday, we got a goose with the coup takeover attempt in Libya, which took some oil off the markets. So that's kind of, oil right now is just very geopolitically biased. So, it's a headline number every day. We had oil inventories build up this past week, and, traders are pointing to a stoppage in one of the flows of getting oil to the where it needed to go. So they blame that as a reason why we had to build up. But you know what? You can find a reason for anything, oil up or down. Remember, as long as in general, the general principle is as long as global growth is growing, then oil should essentially grow with it. Not correlated one to one, but we should see that. So if we get a China trade deal, some of that's also priced into oil. We will see a pop in oil also, probably taken up even higher than where we are. But now look at gasoline. Gasoline, and look at the regression channel I put on gasoline. I mean, this is just to the roof, right? I mean, we had a buy signal here also a little bit later, maybe early January on gas, but this has just been off to the races. Okay, this too is going to slow down, but we're not ready for it just yet, but it will. Okay, so just be ready for that kind of move. And then nat gas, we've already done our short trade in nat gas, and you could see this is my downside target around 246. So if anything in natural gas, doing bear call spreads, do them as spreads instead of naked short and naked long, because as that company found out, you can go out of business if you're on the wrong side of the trade. So here we are right here on nat gas. Now, if we look at metals, I will show you palladium here, and for our members, this has been a great day trading vehicle, as well as for those that have, at least a quarter mil, 300 mil, or 300 mil, 300,000 to 500,000 in your portfolio. This was a great 120 minute to 240 minute, even if you've got about a half a million in your portfolio. And we got members that are trading this to the downside. Right in this area here, we had a trigger to the downside. And I said it would probably get a little bit of a lift here at the 2.3, but again, it overshot a little bit. And we came all the way down almost to the 38 fib node, right? And we had a little bit of a reflex bounce and then a roll back over, and now we're sitting here again. All right, keep in mind it's $100 a point, guys. So we went from about, let's say you didn't get the peak. Let's say you got it at about 1,500 and then you got out around 1,350. So that's a 150 point move. So it's $15,000 a contract in a very short period of time. Remember, these bars are day bars. They're not weekly bars. So it only took you less than a week to pull in, 15K per contract. Okay, so that's where we are with palladium. I still think we're going to get a little bit of a reflex bounce higher, and then it's going to roll again. I'm calling for palladium to come back down around 1,200, 1,100 area here, but this was low hanging fruit, guys. We love these in our commodities area for members that like to trade a little bit bigger. If you put this on a tick chart, obviously you want to only be playing shorts, not longs, and you wait for a rally and then you pick it up and then you short it. So just really, there's still great day trading in palladium, and because they don't have options, it makes it really good for day traders, because longs they're forced to get out of the trade because they can't hedge it with long puts, right? There's just no options to hedge the trade. So that's kind of when everybody gives it up, they all move to the exit door at the same time, and you have these huge. It only took 2 days to go from 1514 down to about 1304, right? So about 114 points in 2 days. That's 14,000 per contract in 2 days, guys, just so that you know. So that's a little bit about that. And of course, if we look at gold, we're off our cup and handle. Remember, down in this area down here, I was calling for, bull put spreads right here. And then right in this area here, I said, okay, we're going to form a handle on a cup and handle. We came up and then we just gave it up. The US dollar is very strong, and that's keeping us in that. If we look at the US dollar, speaking of currencies, let me come back because I think I passed over it. If we look at the US dollar on a daily basis, it just looks very choppy, right? I mean, it is up, but kind of choppy, right? I mean, we've had down, up, down, up, down, very choppy, but up. If I change this to a weekly chart, you can see clearly we're moving up, right? Looking at this weekly chart, we're trying to bust a move through this huge resistance zone right here. You can see my price over volume, and we've got a huge resistance zone there, and then you can see another resistance zone around 98.85. This is the dollar index. That would mean other currencies are weaker than our currency, which then forces the dollar up. So clearly, off the lows in February of 2018, the dollar's been on a tear. So now we're just in this long consolidated mode. If the dollar breaks out, it's going to run, and that will pull oil and most other commodities back. um, on this quick, sharp breakout here. Okay. And then, of course, if we look at the euro, let's come back to the daily. Okay. And I'm going to show you the euro here. Why? And I'm just not a believer long term in the euro, but day to day, up, down. You can see the regression channel in here. If I were to step it out on its daily chart, you can clearly see the direction of the euro. We're making a series of lower lows, lower highs. And unless or until we break out of this, my stance is still I want to sell any rally in the euro. So we're down below a value area here of 113. Could we come down lower? Probably, but we're in an area where I wouldn't want to take a trade. I want to get into an extreme position, either down at the bottom of the regression channel or up top, before I take a contrarian play on it. But remember, shorting the euro longer term has been better than going long the euro longer term. And that's really been since the summer, last summer, right? I mean, the euro really got overextended, in my opinion, up here, and then it just gave it all up. I mean, in a very short period of time, and then it's just been choppy all the way down. We look at the British pound. I've liked the British pound to the upside. And the reason why I like the British pound to the upside is they're betting that the politicians across London are going to be like, well, politicians. That means if we can delay it, we'll delay it. So if we step it out just a little bit here, let me step this out a little. You can see here, and let's just switch the chart. Let's back it off and come back into a daily. You can see here, the British pound is now down towards a lower end right here. So I would be looking at a possible rally in the British pound. You can see this regression channel every time it tends to get down here. Now, if we have a clear break and it breaks this green pivot level here, this green bar represents a pivot low on a daily chart. If we break that, then I think we're going to come down a little bit further. Okay. And I think there's just a lot of confusion in the London markets right now based on what they're doing with Brexit. To me, it's like toilet paper stuck on your shoe. You can't get rid of it. And these guys just need to, get the cojones and big ones and just say, we're going to get out. I mean, these politicians, they don't know whether to shit or go blind, I guess. But that's, I guess you could say that about politicians all over the planet. So that's a little bit about what we're looking at. And we got things setting up in the ag market and in the meats market. I will spend time talking about that with our members this Sunday evening. If you're not a member, I highly encourage you to come in and check us out. Otherwise, make it a great weekend. I think I'm going to take a gander over to the beach and maybe do a run on the beach. I think that would be a good thing for me to spend my Saturday afternoon. Then I'll cap it off with a beer and a frosty mug and a bacon cheeseburger with mayo. How's that for a contrarian play this afternoon? All right, everybody, have a great weekend. Members, I'll see you Sunday night. If you're not a member, love to have you come in and join us. Take care, folks. Ciao now.